Everyone. Thank you for taking the time out of your busy schedule to listen in to our webinar today. I am Scott Tomlinson. I'm the managing partner at High Rock Capital, and normally my colleague and partner Paul Tepsich would be joining us on the call. However, Paul is tied up today with some research meetings, so I'm going to go it alone. Just to recap a little bit about High Rock Capital. We're a portfolio management company that provides our clients with a unique blend of holistic wealth and portfolio management by offering an unprecedented conflict of interest fiduciary responsibility to our clients. And we think this is a really important thing. We know that there are no other portfolio management companies that offer this same level of fiduciary responsibility. So again, we think we stand alone in this regard. We also, and secondarily, want to make sure that we're bringing the best possible client service to you, but also at the same time trying to keep the costs as low as possible, because we want you to keep more of the growth that your portfolio earns for you, so you can compound that through the years. So that's just a little recap about our what we want to do at High Rock and what we do for our clients. Today, though, I want to focus on the global economy as part of the discussion, because we've basically been through the first quarter of 2015, and most of the results for the first quarter are in. And what we have noticed is that the first quarter was certainly not a good one for global growth. And there's a number of reasons for that, but a lot of it has to do certainly with the struggles that the global economy has been having recently. Certainly in the Eurozone, we've seen the deflationary issues arise that have prompted the European Central Bank to be very aggressive with its monetary policy, trying to get the stimulus needed there to build the confidence of the European community to get out and start investing in the economy again. However, still there are a number of things overhanging the European economy. Certainly Greece is one of those. We have seen today that there are some developments in a positive way that looks like Greece will get another bailout, but there are still some political issues that the Greeks have to deal with on their home front in order to be able to move forward, and that will continue to overhang the European economy. At the same time, we have seen some better economic data out of Germany, and that is certainly the leading country for the economic situation in Europe. So we're very, at this point, cautiously optimistic that there will be some continued improvement in some of the economic data coming out of Germany, and quite hopeful that that economic data will continue to help the balance of the European community as well. News out of China has not been positive. Again, there is some concerns that the official 7% growth rate may be in jeopardy. Well, that it remains to be seen, but certainly the numbers that have been coming out of and coming out of the manufacturing sector have not been promising, and so looking forward into the second quarter of 2015, there are a lot of questions that remain to be answered about which direction China is taking. So we're all going to be monitoring that very closely. But at this point, again, we think that all of this is warranting some caution, and that's our view at this point in time. Is we want to continue when we're looking at how to manage our clients' money. We look at a lot of things, the global economy in a broader scale, and the direction that it's taking. Not only the direction that it's taking, but how is it comparing to all the expectations. the expectations going forward are that we will start to see some improvements in a number of places, and one of those very specific places is the U.S. Now, once again, first quarter of 2015 for the U.S. economy was not a good one. The U.S. economy stumbled. A lot of analysts and economists have put that to the weather. Certainly the weather was and did create difficulties for the economy, certainly not as significant as last year, but certainly there was some issues, certainly in the Northeast, with the amounts of snow that were received. But not only that, the strength of the U.S. dollar has been an issue. While the Federal Reserve has been trying to determine when it wants to normalize or begin the process of normalizing interest rates in the United States for a significant period of time have been at zero. The U.S. Federal Reserve wants to start to get interest rates rising again to normalize the interest rate situation. But as the U.S. dollar has been as strong as it has been in anticipation of higher U.S. interest rates, it has had a negative impact, almost a tightening effect on the U.S. economy, and that also has contributed to some of the slowdown. It's difficult to say how much of the impact has been U.S. dollar based, how much of the impact has been climate. But one of the things that we do know is that the global economy has definitely been looking to the U.S. economy to help pull it through its economic difficulties. And that was made very clear this morning in the Governor of the Bank of Canada's testimony to the House of Commons Standing Committee on Finance this morning. Governor Paula said, yes, the Canadian economy was certainly struggled in the first quarter of 2015. A lot of that had to do with the oil price shock that the Canadian economy was given in the latter part of 2014. But the real key, or what I noticed came out of that testimony on more than one occasion, was that there is an expectation that the U.S. economy, or the strengthening U.S. economy, will pull the Canadian economy along in the second half of 2015. So generally speaking, there's a lot riding on the U.S. economy. Now, in the U.S., we have the FOMC, the Federal Open Market Committee, meeting today and tomorrow. They'll be announcing their news, or they're making their statement as to what they've discussed and what the gist of their meetings have been about. These statements are watched very closely by the financial markets, and the financial markets are going to be trying to determine what the next steps will be for the Federal Reserve. Will they, as most expect, start to raise interest rates in September, or is the global economy and the U.S. economy, are they struggling enough that they may think about postponing that decision? And those are things that obviously financial markets are very concerned with. And certainly, obviously, we have to be monitoring that too. Now, we tend to want to take a broader and more long-term view when it comes to investing our clients' money. And we want to make sure that when we put money to work, especially put new money to work, that we're getting and putting that money to work at times that make sense. If there is uncertainty, if we feel the need to be cautious, we will probably not be as aggressive putting new money to work in a short period of time while we wait for developments that will give us a little bit more confidence that by putting money to work at a certain period of time, we can then get the best impact for that, putting that money to work. So it is a longer-term perspective that we take when we invest, but we also have to look at some of the short-term market situations. And one of those short-term market situations that we've seen evolving over the last little while has been the U.S. The U.S. earnings versus the price of the securities in the market. And we monitor the S&P 500 very closely for this because there's a lot of data about those 500 different companies. And as part of our investment process, we will own the ETF that is the S&P 500 index. So, and as the S&P 500 is a global benchmark index for equities, a lot of things that we look at in the S&P 500 are going to have some repercussions on a global scale. One of the things that I'm popping up here on the screen is the change in the 12-month earnings per share of the companies in the S&P 500, and that's the blue line that you see. And you can see that back in 2008, 2009, the S&P 500 earnings certainly were in decline as the equity market declined, and it is the U.S. S&P 500 earnings that have tended to lead the market subsequent to that. So throughout 2010, 2011, into 2013, the forward expectations of earnings per share growth continue to lead the green dotted line, which is the S&P 500. However, since the beginning of basically 2014, that has not been the case. The S&P 500 price index has continued to rise. Meanwhile, earnings per share, while rising some, have not risen to the same degree as the S&P 500 index. And you can see more recently that earnings have started to come down, and even though they are somewhat better than had been expected, they're still declining, and the stock market continues to move higher. We think that suggests that right now equity prices to a large degree, especially in the United States, are somewhat overvalued. And again, another reason that we think it's important to be cautious as we move forward. I mentioned the U.S. dollar before. I just take a quick look back at a chart of the euro against the U.S. dollar, but you can certainly see that the U.S. dollar, or the weakness in the euro and the strength in the U.S. dollar, have been significant in the last little while. And we know that that has been a significant factor because it makes U.S. exports significantly more expensive and obviously difficult for U.S. exporters to be as competitive selling products in the U.S. or outside of the U.S. It also has an impact of significance because a lot of U.S. companies do sell outside of the U.S. and their earnings are going to be a function of this U.S. dollar situation, and the U.S. dollar strength has definitely had a negative impact on U.S. earnings. And not only that, of course, lower oil prices have definitely been hurting the U.S. economy and the U.S. oil companies' earnings as well. So lots of things to consider when we talk about the global economy, but just to touch back on that global economy again, is that our views going forward is that there are some headwinds, and those headwinds are developing. And while everybody seems to be hoping that the U.S. economy will continue to expand in the second half of 2015, that is what the global economies, or that is what global economies are anticipating will help carry them through 2015 while they continue with their stimulative monetary policies in Japan, in Europe, in China, and in Canada, as well as in emerging markets. And you can see on this IMF data mapper the expected growth rates going through to the end of 2015, pretty flat for developing economies, but the expectations for emerging economies are somewhat higher, and they do anticipate that it will be emerging economies that will tend to drive growth on a global scale. Well, at the moment, these are economies that are continuing to struggle. China and other emerging economies continue to struggle. So if there is a downgrade to the emerging economies into the future, into 2015 and on into 2016, then that will have a likely impact that won't be positive for the global economic situation. And I think that the U.S. Federal Reserve has to consider this before they start to begin the process of normalizing interest rates. So while most economists expect that September will be when that begins, and it may likely be that, however, over the longer term, higher interest rates are probably not in the cards in any significant way, as long as there are question marks surrounding the potential for the global economy. So I'm not going to continue longer on this topic. I think that we've given you some pretty solid understanding about why we continue to be cautious. We definitely want to see more data come to us in the second half of 2015 before we get any more positive. So in essence, we're cautious. We are cautiously optimistic, but cautious nonetheless, and that for us is important when it comes to protecting our clients from what might come in the second half of 2015. So on that note, I will say if there are any questions, please feel free to bring them forward. Okay, well, if there are no questions, but if you do have questions, and if you're listening to this recorded version, which we will have on our website, and you do have any questions with regards to my commentary today, or any other questions with regards to what we do at High Rock Capital, please feel free. Send me an email, send Paul an email, send Bianca an email. We are all always available to comment and answer questions. But thank you again all for tuning in. We certainly appreciate you taking the time, and we'll be back next week with another webinar, and if there are questions, hopefully we'll be able to answer them then. But this is Scott Thompson signing out, and wishing you all a great week, and I look forward to hosting you again next week. Thanks so much. Have a great week.